Markets have been a little bit firmer this morning with US index futures rising alongside European indices. Sentiment has improved a little bit with technology shares rising following that big sell-off we saw on Friday, while weakening oil prices and stronger than expected Chinese trade data have also offered support. But the key question remains as to whether this is just a short covering bounce or whether this is the start of another leg higher for equity markets and indeed risk assets in general. Let's get into it. Looking at the S&P 500 here, we can see that the index has bounced back from prior support zone around the 7,335 area, where previously we saw a couple of bounces before the index broke to new highs. But following that big drop on Friday, the key question remains as to whether this is just a technical oversold bounce or whether the buyers have stepped in and defended the market once again. Time will tell, but we will proceed cautiously while key levels like 7,500 remain above market, where previously the index had found support from that prior resistance level and psychologically important level. So that area remains the key zone to watch in the next couple of days should we see the recovery extend a little bit further. It's also worth keeping an eye on Monday's high at around 7,466, and the key question there will be whether there will be acceptance above it should we go above it, or do we get a quick rejection and a move back below. If it's the latter, then that would be a bearish move, in which case the next downside target would be liquidity resting below Monday's low and that level of price support at around 7,334. So we could see a short-term move higher above Monday's high and then a drop to take out liquidity resting below these triple bottom lows now. That's my base case scenario given the technical damage that's been incurred. For example, the index has broken below the 21-day exponential moving average, which is objectively a bearish signal. But obviously the long-term trend is still bullish. We are miles away from the prior all-time highs and the 200-day moving average. So we could see the market consolidate here or pull back a little bit more before the bullish trend resumes. For now, it's a market to trade from one level to another, and we've got clean technical levels to watch for in terms of direction. For example, if we go back above 7,500, I think that would be bullish. While we remain below it, the technical buys would be leaning slightly bearish in the short-term outlook. Gold has bounced back a little bit here, but the underlying momentum is bearish given the metal is down now for the fourth month in a row, and it has broken some key technical levels thanks to a strong US dollar and the recent rise in bond yields. Now, the key level to watch is this area here. I've shaded it in white. You can see that the zone was previously a major support area. We've got a couple of rallies away from this area before price broke below it on Friday. So now that we are below that zone, this is objectively bearish, and for as long as we remain below this zone, the path of least resistance will remain to the downside. So the key question now is, where do we head from here? Well, given what's been happening in the gold market in the last few weeks, the momentum is certainly bearish, and for as long as we now hold below this zone, I think we could be heading down towards the March lows, if not lower than that, provided that the US dollar remains strong and we don't see a collapse in incoming US data or oil prices. If those situations don't arise, then my view is that we could potentially retest the zone, or maybe not, and hold below it, leading to a potential drop to take out liquidity that would be resting below the March low of just under the 4,100 level before the market potentially bounces back. That's my base case scenario. Alternatively, if we don't see any selling pressure, I think that would be very strong bullish signal, right? Because this is a well-defined support level that was taken out. So if we now reclaim the zone and go on to take out the high from Friday's range, this level right here, at 4,481. If that level were to give way now, I think that would be a strong bullish technical signal because of the lack of downside follow through. Usually when markets don't react in the way you'd expect is when you get sharp moves in the opposite direction. So That's the alternative scenario I'll be watching for in case we don't see the selling pressure that I'm now expecting that we might get from this zone. So those are the two scenarios I'm watching out for. My base case, as I mentioned, is that I think gold prices are heading lower, but if I'm wrong, if that doesn't happen and we go on to break Friday's high, then in that case, I would have to drop my bearish view on this market, and in that case, we could well see a sharp short covering rally in the gold market. This right here is the daily chart of the dollar Swiss, and the reason we are looking at this currency pair is because we've got a beautiful level coming into focus around this zone of around 79.25 to around 79, the figure. This level, as you can see, was prior resistance. We broke cleanly above it on Friday of last week. Price is now in consolidation mode. What I'm expecting now is for this former resistance level to turn into support, leading to a bounce towards 80 initially, possibly 81 thereafter, because we do have a double top here at around 80.41, and there'll be lots of stops resting above that level. But given the bullish price structure that's been built underneath this level, I think in the coming days we could well see the dollar Swiss move to take out that liquidity pool. So I think the path of least resistance on the dollar Swiss is still to the upside, despite price coming back down a little bit. Now, if you look at all the bearish looking price candles in recent trade, for example, this bearish engulfing candle or these inverted hammer candles that were formed below the 200-day moving average, you would have expected a continuation to the downside, but that didn't happen, right? Instead, we broke higher. So it looks like the bearish traders are getting trapped in this market. And so given the strength in US data that we've seen, for example, the non-farm payrolls report on Friday came out much stronger than expected, and inflation numbers have been quite strong in the US lately. So fundamentally, the dollar has been supported, and that's not to mention rising oil prices, of course. Given all those macro factors and this technical breakout, I think the dollar Swiss is headed higher from here. And the key level that I'll be watching, should we get there, is at around 79.25 on this daily time frame. Thanks for watching. Don't forget to like this video and subscribe to our YouTube channel. For more market updates, head over to the news and analysis section of our website at FOREX.com. See you in the next update. Take care.